February, the month of love, but also the month of opportunities. Indeed, today we'll take a look at 3 of the most undervalued stocks on the market right now. So you'll find 3 companies that could be pretty interesting for you to have on your watch list for February of 2025. First up on my list is one of the largest semiconductor companies that has been on quite a certain downtrend lately, which is the American chip makers Nvidia with the ticker NVDA. On January 27 of 2025, many investors woke up to a harsh reality where we've seen the stock market plunge by close to 2%. This small market correction came after the realization by many investors that the American AI companies might not actually be the best ones in the world. Indeed, on that Monday, the technology sector as a whole has been put under a lot of pressure after we've seen the app from a Chinese artificial intelligence startup called DeepSeek that has surpassed OpenAI's ChatGPT as the most downloaded free app on the Apple's platform. This was one major blow to one of the largest companies in the entire world, where we've seen Nvidia lose close to $600 billion of valuation throughout that day, or close to 17% of its total value, which actually represents the biggest one-day loss in US history in terms of the market cap. But the main reason for this massive market wipeout came in December last year. At the end of last year, DeepSeek unveiled a free open source large language model that it said took only 2 months and less than $6 million to build. And to do this model, they've used the reduced capability chips from Nvidia called the H800S. The main and the biggest competitive advantage of Nvidia at the moment is that it is the world's largest producer of graphic processing units, aka GPUs. These GPUs will usually be used for different purposes such as gaming, doing some editing software, and in that particular case, AI. The main difference between Nvidia and our main competitor AMD is the fact that Nvidia is widely recognized as being able to produce some higher quality products. This has made that over the past couple of years, the great Nvidia GPUs have been able to dominate the market, where we've seen giants in the technology sector such as Alphabet, Meta, and Amazon spend billions of dollars on them. So with the Chinese DeepSeek company that is able to be more efficient in the number of GPUs that is required for their different AI models, this kind of ring a certain bell for all of these tech giants that are spending billions of dollars buying the different Nvidia products to create their own AI resources. While these news have obviously been frightening many investors in the possibility that the total sales of GPUs from Nvidia could fall over the next couple of quarters, I personally see this decrease of the value of Nvidia as an opportunity. At the moment, Nvidia remains the one company that is essential to pretty much all the different tech companies in the entire world. So, following the supply and demand rule, it means that they pretty much have a monopoly on this market, meaning that they can price their GPUs at the price that they want. In fact, we can see that with the more recent statistics on the GPUs market, we find that Nvidia is currently the leader with close to 90% of the total market. Plus, it is important to note that this market is expected to grow at an astronomical speed for the next couple of years, where it is expected to reach over $2.74 trillion in 2029. And this project growth has actually been priced in the value of Nvidia over the past year, where it has increased close to 100% and where it has increased close to 2,000% over the past 5 years. This has also been reflected in their latest earnings report, where we've seen the company increase their total quarterly revenue by over 95% year over year, up to $35 billion. And despite an increase of 44% year over year in their operating expenses, the company has still been able to massively increase their net income by over 100%, up to $19 billion. Taking a look at the valuation of Nvidia, we can see that despite being worth close to 3 times its value at the end of 2023, its current price to earnings ratio is about 2 times less expensive than it was at that time. It is also quite cheaper to invest in Nvidia right now compared to its big competitor AMD that currently has a P ratio exceeding 100. So overall, with the great project expansion that is forecast for the future in the AI field, all of these companies will definitely need to have some great semiconductor chips in their different projects. It is why a company like Nvidia that currently owns close to 90% of that market will be particularly valuable for the future. But now for the second pick on my list, we'll be going on a completely different sector with the company Target with the ticker TGT, known by many as being one of the cheapest places to go shop and one of the world's largest retailer with over $100 billion of revenue in 2024. Target could be particularly interesting for multiple investors valuation-wise with a P ratio of about 15 right now. After being on a certain downtrend momentum over the past year, we've assisted to a certain regrow in valuation of Target over the past weeks. Nevertheless, to understand why that company is currently trading at such a low price-to-earnings ratio, we need to understand what are different factors that have caused this. And one of the main reasons that can explain this is the poor earnings and financial results that the company has been reporting lately. Indeed, with disappointing third quarter's earnings report where we've seen the company hasn't been able to beat the analyst predictions for both the quarterly revenue and the total quarterly earnings per share, this has been showing clear signs of weak consumer discretionary spendings as well as rising inventory costs and compressed margins, which has made the investors lose confidence towards the outlook for the future concerning Target. When you combine this with growing and fierce competition with other different retailers and a shift towards more essential purchases by consumers rather than discretionary items like apparels and home goods, this has made that Target wasn't in the good grace of multiple investors that have decided to invest their money somewhere else. Now diving into the third quarter earnings of this company, we can see that despite having a slight increase in their total quarterly revenue, the important increase in many of their different expenses have been significantly decreasing their net earnings year over year. The only positive point about it is that over a 9-month period, we can still see that these net earnings have been able to increase by over 8%, showing that the last earnings report was not a great representation of the financial strength of this company. Also, with the rapid switch of consumer buying spendings that we've seen throughout the pandemic, where most people have started to buy online, this makes that all the retailers in the world needs to adapt their business model to this new e-commerce trend. On their side, Target, despite being with important giants of the retail sector such as Amazon and Walmart, is still able to have close to 2% of this total e-commerce retail market, where it is actually able to generate over $300 million of revenue per day. But the big advantage of Target compared to their big competitors such as Walmart and Amazon is that their price to earnings and their forward PE ratios are quite lower than them. Add to this, what differentiates them compared to these big competitors is the fact that they are also distributing a way bigger dividend that is currently close to 3% of yield. So on your side, if you are looking for great steady passive income from these dividends, Target might be a wise pick to add on your watch list. Finally, for the third and last pick on my list, I've decided to go back into the technology sector with the business Alphabet with the ticker GOOGL. Even if this American tech company hasn't been talked a lot compared to a company like Nvidia over the past couple of weeks, it remains one of the most undervalued tech companies on the market right now. With a price to earnings and a forward PE ratio of about 25 right now, it is about 2 times less expensive compared to the average technology companies. And so why is that happening? The main reasons that could explain the fact that Google is quite undervalued compared to some of its peers right now is the fact that they are currently facing a lot of different antitrust issues. Indeed, Google is currently in the midst of multiple antitrust lawsuits from the United States Department of Justice and from the Competition Bureau of Canada. The lawsuits allege alleged that Google has illegally monopolized the search engine and advertising technology markets. These lawsuits have been going on for ages, but it is, in my personal opinion, about the big competitive advantage that Google has, which is its extremely strong search engine. By holding close to 90% of the total search engine market, Google has been able over the past couple of decades to establish themselves as the #1 places if you are looking to search something online. It is an extremely valuable commodity to have in their business model, especially in our day and age, but it is not the only commodities that they have. Google also has its widely used browser, Chrome, that is used by over 3 billion users. When you combine this with other interesting products and services such as Gmail, Google Drive, Google Map, their AI Gemini, Google Pixel phone, Waze, Waymo for cars, and their famous YouTube, it is fair to say that Google is currently one of the most diversified technology companies on the market. Add to this, in their latest earnings report, we've seen that Google has been able to surpass the analyst predictions for both the total quarterly revenue and their total earnings per share. In terms of their quarterly revenue, we've seen that they've been able to increase them by about 15% year over year, which has driven up their net income by over 33%. This was well justified by an increase in both their Google service sales and their Google Cloud revenue. Another element that is proving the financial strength of Google is the fact that over the past quarter, they've been able to increase by 11% the total stockholders' equity while diminishing by 2% their total debt. And so, with all the big perks and advantage that this American multinational offers for the future and with the low valuation that it currently has, I personally believe that it is a great company to have on your watch list right now. So there you have it. Those were the 3 most undervalued companies that you can find on the market in February of 2025. However, if you're looking to invest in the stock market with a different approach by reducing your overall risk and by balancing your overall portfolio, another way for you to do it is by investing in great exchange trade fund, aka ETFs. So to find what are the best ETFs to invest in for 2025, check out the video that's gonna be right over here, and I will see you soon. Peace!